Good evening, everyone. A very warm welcome to all of you to this special session on integrated business solutions organized by Board of Studies Academic. We are pleased to have you join us and truly value your presence today. The IBS paper stands apart from traditional subjects. It doesn't just test your knowledge of rules, standards, regulations, concepts. It places you in the role of business decision maker. Here, you are not working in isolation, but navigating the real scenarios where strategy meets finance, taxation, laws, and other compliances. This session is your gateway to understanding how IBS paper is designed to simulate the complexities of actual business scenarios, sharpening your skills, think critically, application of holistic approach, and strategic thinking. Let us take a simple example. Imagine a listed hospitality company planning to expand its operation by setting up a luxury eco resort, okay, in a prominent tourist destination. At first glance, this appears to be a forward looking strategic move, aiming at capitalizing on the rising demand for sustainable tourism and premium travel experience. However, such a decision is far from isolated. It intersects with multiple financial, tax, regulatory frameworks. Since the company is listed, since the company is listed, SEBI LODR regulations is very important. Any material expansion plan must be appropriately disclosed to stock exchange, thereby ensuring shareholder transparency and supporting good corporate governance. From a direct tax perspective, if the eco resort qualifies as an infrastructure facility under applicable provisions, the company may be eligible for deduction or incentive under various sections like Section 80 IB of Income Tax Act or other region specific capital investment schemes. On the indirect tax front, accurate classification of services such as room tariff slabs, banquet services, and bundle tour packages is critical to determine the applicable GST rate. For instance, room price above 7,500 attract a highest GST rate than budgeted accommodation. Moreover, seamless input credit management on construction cost, fittings, etc. are very relevant. From a financial perspective, the hotel's expansion would need planning to decide how to fund the project, whether by using own profit, taking bank loan, or borrowing from foreign sources. If you go ahead with ECB, external commercial borrowings, then FEMA compliances or other RBI compliances becomes relevant. Therefore, it is very important to think holistically. What seems like a simple business expansion is very important because it is there is multiple layer of strategic planning, financial structuring, tax optimization, and regulatory compliances. Today, we bring interesting case studies from the case study digest. First case study is on reputed hotel company listed in stock exchange. This case study covers Section 197 of Companies Act, read with Rule 51 of the Companies Act, SA 260, SA 570, SA 240, FEMA Regulation 2022, Section 185 of Companies Act 2013, Ind AS 109, and discussion on supply chain management and branding. Second case study is online gaming company, which covers Ind AS 101, Section 173 of Companies Act, Rule 31B of CGST Rules 2017, as well as McKinsey 7S and product life cycle. All the case studies material are available on BOS Knowledge Portal. Today's session will be interactive, so please feel free to ask any question, whether in English or in Hindi. You can either speak up or type your queries in your chat box. Additionally, the last 15 minutes for your general queries. We are fortunate to have us today CA Nilanjan Paul, a well-known chartered accountant. He is currently director in Big Four firm and having outstanding experience in statutory audits. His expertise will help you to connect theory with practical business scenarios. With that, let us begin today's session and explore this insightful business case study. CA Nilanjan Paul, sir, over to you.
Thank you, Deepak. I hope my voice is audible.
Yes, sir.
And thank you, Deepak. And I must thank the Institute for giving me this opportunity to interact with the budding chartered accountants. And as I think Deepak said, it is quite relevant. The subject that we have is an intersection of various topics that we have read in our CA curriculum. So the idea is to have a very holistic and a common decision making, considering all the relevant laws and regulations. So as Deepak also mentioned, I think we will have two case studies today. One will talk about and both are very prominent sectors in that sense. So online gaming is where a, a new age and a budding kind of a sector. So we'll try to explore its nuances and possible probing questions, which you would find very interesting. Similarly, traditional hospitality listed entity, where you would have its own sets of challenges, how you try to look at expansion, how you would try to look at challenges from other laws and regulation. Before I start with the slide deck, I would like to reiterate what Deepak also mentioned, is to make this session more and more interactive, right? So it is that we are trying to help you and share our experience. But wherever you guys feel that something is unclear, please feel to ping me. I am sure there is a way to pass on that message. And I don't want to be a monologue, but we can have interactive discussion. So with this, let me share my slide with you. Yep. Yes. So as I said, we would like to start with illustrative hotel company. It is known as Sartaj Hotels. It is expected to be India's largest and listed hospitality company. So I'm sure in our lives as well, we would have been experienced with some of our hospitality sector, be it hotel, be it food, be it vacations, or be it some luxury experience. So we can visualize when we go through this case study. Now, as far as this entity is concerned, it is a leader in the industry. It has more than a century of existence. It is 120 years old, and it is renowned for exclusive properties, experiential services, and distinctive brands. Now, one of the very important differentiator is that they have a very significant focus on sustainability and ESG initiatives. Hotel, as we know, is a very service-oriented um, uh, enterprise, and as we would visualize uh, the strained resources, for example, water or food, uh, is a very big drain on the entire nature and ecosystem. So I think this also aligns with the overall objective of having a more sustainable and environment conscious corporate citizen. So that's what Sartaj Hotel stands for. Now they have a very unique brand recall identity. Whenever you enter into a Sartaj Hotel, you could feel the exclusive service. You would also be able to experience the personalized feel which each and every guest would encounter. They call it the Sartaj experience, right? The company is also deeply rooted in values, legacy, and they are also trying to have a more future oriented and futuristic kind of a brand, considering the change of the clientele, right? So it is not just traditional age old kind of a enterprise, but it is an agile, forward looking, and a very constructive entity in that sense. But yes, they all have also tried to balance this with speed, synergy, and success, where they have not compromised on the quality of service that they are known for. They have a portfolio of brands, and we'll see in the next slide what those brands are. But primarily, if I have to split it up, they're into luxury, they're into upscale properties. They are also into budget segments. So all in all, the entire range of properties they are involved. Now, these brands are also strengthened by innovation and service experience. One thing that I'm sure you and I would very well relate to is whenever you enter into a hospitality kind of a setup, the one item which always look for is the experience with food and beverages. So as far as Sartaj is concerned, hotel food services and hotel food particularly are integral part of that hotel business, right? They provide with exceptional food services, innovative cuisine. They would like to modernize um, traditional food and experiment with new age technologies. And this will obviously be coupled with entertainment and various events. So, all in all, a wonderful experience the Sartaj Hotel which offers to its customers. Let's see what are the other brands that they have. Yeah. So, these are the four categories of brands that they have. They have King's Corner, they have Hocus Pocus, they have Stories, and Silver Line. So, if you would see from a number perspective, King's Corner as a brand, they have 110 hotels, and in that they have around 17,000 keys, which means they have 17,000 rooms in so many number of hotels. It's a very strong sector. It's a very strong brand. They contribute around 936 crores of revenue, a very significant portion of the overall revenue of the entity. King's Corner as a brand stands for spacious suites and premium furnishing and state of the art technology. There is the other brand called Hocus Focus. It is exclusive, but it is not as luxurious at King's Corner. But it is still kind of a luxury brand, but not a very uber luxury kind of a brand. It's still exclusive, and it is around 96 hotels, and it is around 11,200 keys, right? So, and it contributes around 195 crores of my revenue. Similarly, I have two more upcoming brands. If I have to talk about Silverline, the most upcoming and sought after brand, where the entity is trying to focus on wellness related experience. You will have spa services, spa treatments, nature walks, and a very close relation with the nature and your surroundings when you would experience a Silver Line branded property. We also have stories, which is more like a budget kind of hotel. It is like it will focus on practicality and design. Probably it is suited for a person who would like to spend 1 or 2 night in a particular place, come there for business, uh, and then primarily would like to move out to their hometown or residence after they have completed their uh, uh, official work. So if you would see, these four brands are very well integrated with the overall business philosophy of the uh, entity. So the way we have also focused today's session is that the fact pattern are split into topics. We have tried to disaggregate and put the relevant facts along with the questions. So it will be easier for all of you to navigate and also to comprehend in a better way. So let's start with the first set of discussions, right? So we talked about four. And there are four options, if you could see on the screen. And I would like you to think and then possibly respond. That out of these four options, what do you think is the correct option? So if I have to spell out the question is quite simple. It says that why has Sartaj Hotels opted for different brands, right? King's Corner, Focus, Stories, and Silver Line. So then there are four kind of options. One is one is that uh, one is that that we have to increase the operational efficiency. Second is to focus solely on high-end customers. Third is to minimize investments in food and hospitality. And the last is to target customer segments. So I'll just pause for a minute and I'll see what do you have in your view as the option. Yeah. Sorry. Yeah. So Smriti, according to you, it is to target a different customer. So are you suggesting the option four, the last one?
To increase operational efficiency.
You are saying the first one, okay? Neha, it is to target different customers. I think the idea is to diversify and to look at a newer. They are very well focused on various type of properties. Stories would be budget friendly, and Silver will be exclusive and upcoming. So I think it makes sense because you then offer a very wide, and you're not, I know your customer is not concentrated towards one particular class or one particular preference of individuals. So you are offering yourself to a very, very wide range. So how it happens in a business scenario is that you are able to hedge any downturn or a shift of consumer preference. So, for example, if you would have been focused only towards a premium or upscale experience, or let's say you are focused only on budget friendly accommodation, if there's a shift of preference or if there is a economic disruption, it kind of affects your operations also, right? So I think this is a way to diversify and hedge ourselves, right? to 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 a very wide set of uh, of experiences and customer. So I think the option four, I think we all or a majority of us of our felt that option four would be the correct is to diversify and to target a wider range of customers, right? So let's look at a different fact pattern plan and the business objective. Let's talk about an audit scenario. So let's assume that the audit of this entity is going on, right? And there is a planning meeting that is going on between the auditors and the management or those charged with a governance. I think we have specific auditing standards, which will talk about risk identification, risk assessment, and to have a planning discussion. So let's assume we are at that stage. Now, the auditor and the client is discussing. The management of the entity informed that a substantial portion of the revenue is generated through cash sales, right? Let's say um, out of 1,000 crores, a substantial portion is through cash sales. And if you would recall in our experience as well, when we were dealing with a hotel kind of a sector, a cash is one of the most common form of transacting, right? So even though we have UPI and other digital methods, but still in certain places where the connectivity and all that is not strong, you might end up paying through a cash mode. So let's assume that it's the crores of cash that has been collected. As far as the KMP is concerned, KMP and the senior management, they often face intense pressure, right, to meet revenue targets, right? Because in practical life, the remuneration, the variable portion of the remuneration of a KMP or a senior management is generally linked with certain operational measures. So one of them is having an improved top line or a very positive kind of a bottom line. So again, that has been an area of focus for this entity as well. Now, this entity also sets targets. That is also looked at by investors and analysts, and is considered as a key performance indicator. Now, when the internal auditors also came in, they also said that we have looked at the internal control system, especially around revenue and cash collection, and they did not observe any significant deficiency in the revenue recognition process. So all in all, everybody felt that it is a key area of focus, but again, there is no negative indicator or a significant control deficiency that have been observed by anyone. So as far as this statutory auditor is concerned, they felt that this statutory auditor that the revenue is not susceptible to risk of fraud because everything is fine. There is no control deficiency. The linkage of remuneration of KMP and senior management with the increased revenue is a normal aspect which you will find in any industry, and hence they felt that a risk of fraud may not be associated with revenue in this scenario. So I just want you to keep this fact pattern in mind because that's gives you uh, a prelude to the next question that we have. So what I want to ask all of you is that you again have four options on this slide, but do you think that the perspective of the auditor to say that the presumptive risk of fraud should not be associated with revenue, is that perspective or view of the auditor is correct? So again, we have four options. First option is that no, risk of fraud exists in revenue because ultimately this is an incentive for the senior management and KMP to misstate or manipulate or overstate revenues. Second option is yes, that the view of the auditor is correct, that fraud risk doesn't exist because under SEBI there is a limit of 500 crores as the threshold for stating an item to be a fraud. Third option could be that there is no risk of fraud, and hence we would concur with the view of the auditor because these performance-based service conditions or key performance indicators are generally common across sectors, right? And hence it would be inappropriate to say that there is a risk of fraud. There could be another argument that these are very common. Cash sales are very common in a hotel industry. So why do you have to link with a risk of fraud, right? Only because you are dealing in cash, that doesn't mean that there is a risk of fraud. So I think Neha has only given her response. If I think Smriti also gave. So if there is a particular point of view, I'll take a pause and I'll wait for you guys to respond. If you have a particular perspective to share, happy to listen. Yeah. Any other views, anyone? So as for Neha, Smriti, and Priyanka, it is the fourth option that there is no risk of fraud in revenue because it is a performance-based condition which is common across hotel. Okay, interesting. Yeah. Any other views, anyone? Yeah. So let me ask this question differently to you. If this is, so Rajiv is the only one who believes it's option one. Okay. Okay. So is Risham. Okay. Okay. So let me flip this question differently and possibly we can discuss that when we talk about risk of fraud in revenue, is that a default risk of fraud or is it a presumptive risk of fraud? Do you presume that there is a risk of fraud, or do you think the auditing standards believe that it is by default a risk of fraud? Can I have some reactions? Yeah. So it is a presumptive risk of fraud, right? So it is not a default by default that in every industry there will be a risk of fraud. Now, the reason for having a risk of fraud, and you would appreciate that auditing standards are sector neutral. They don't cater to a particular sector or a particular type of industry or a particular set of auditors. It is a position that is neutral of sector or the gap that you're following. So generally what is felt is that, and this is common across industries, that when there is a linkage of a remuneration of the senior people with certain revenue linked targets or a profitability targets, there is always a possibility to overstate revenue. If you would recall, there is a fraud triangle under SA 240. The first one is incentive. This is an incentive under the fraud standards on audit, which is to talk about an incentive to commit fraud. So if you have an incentive where you can overstate revenue and you can earn a higher amount of financial compensation, then there is obviously a risk of fraud. But hang on, that risk of fraud is always presumed, right? Because you cannot 100% say that it is always there. But generally, the standard set has felt that if there is a risk, if there is a revenue linked performance measure for a KMP and senior person, more likely than not, there is a presumed risk of fraud. So the standard says that the risk of fraud would exist generally. If you don't think it is, then you can rebut that uh, in your audit documentation. But to respond to this question, question. I think what Rajiva and Resham said is quite appropriate, because revenue in this scenario also is linked with a key performance indicator, and hence it is by conduct, or by generally, it is presumed to be a risk of fraud. Again, it doesn't matter whether it is cash based, or let's say if the entire revenue was recognized through digital means, then the revenue or the quoted the requirement under SA 240, which I think they state that performance-based criteria are considered as a presumed risk of fraud. Yeah.
Excuse me, sir. Good evening.
Hi.
Hello. Sir, the thing is, I got confused while choosing the between option 1 and 4, which led me to choose option 4. I
Okay.
was strong with the reasoning part, but then I ended up choosing the option 4. So, to understand it better, I would
Yeah.
want
Yeah.
to ask the basic principle behind this is that this there is a presumption involved
Yeah.
uh,
Yeah.
in every case.
Yes.
So I found both the both the options close enough. So it became
Yes.
difficult for me to zero down. So I zeroed
Yeah.
down to
Yeah.
the
Yeah.
fourth one, even though that was clear. I
Yeah.
mean,
Yeah. Yeah.
in
Yeah.
mind I had this point clear, but don't you think so? Both of it are like even though contradictory, I mean, but then it is like
Yeah. Yeah.
closely related, so you will end up losing marks by, it is a bit tricky, I mean, I can say so,
So, yeah, yeah.
because
So sorry,
as you
I didn't
say,
didn't
it
get your
is
name.
not Smriti.
Smriti. Yeah, Smriti. Yeah.
Yes,
Go on,
because
Smriti.
the thing is, as a basic principle, if you go, it is just a presumption. It is not
Yep.
necessary that
Yep.
every time
Yep.
it will lead to this.
Yep. Yep. Yep.
So it is judgmental based, or it is on that basis. So how can
Sure.
you conclude? How
Yeah. Yeah.
can you?
No, I
So
think it's a fair question, Smriti. But if I have to talk about the closeness of option one and option four, okay, I would not say that it is a deliberate attempt to confuse, but there is a very good amount of similarity between the way both lines are drafted, and that is exactly the close reading which we want the students to do, right? So if I would have, or anybody would have written just one liner, yes no, probably the selection would have been easier. But when you give a rationale, right, if you would see for all the four options there is a rationale why this option is perceived to be right. It could be a
yes, yes,
wrong rationale, and we may agree, not agree, whatever. But I think the idea is to probe in the mind of the student, is that even though, let's say, if it is yes, which of that reasoning is leading you to that answer. So I think in this entire topic, or on this entire subject, what we are trying to achieve is to have a questioning mind. We think why this is, why this decision is taken, why this assumption is there, right? So I think this closeness of text is there to question yourself before you reach an answer, right? Now the question that you asked next is that how can you say that by default it is, right? Let me ask you a very simple question. If your revenue or if your salary, right, is linked to a particular number, isn't there a temptation, right, to do that? There is always a possibility, right? So the standards on
you
auditing
can't
is
rule
not
out the possibility, but at the same time,
yes, yes.
It's not necessary. I'm still not convinced. I mean, I feel at the same time, it's not necessary that it has to be susceptible every single time.
So that is why it is a presumptive risk. When you presume
Okay.
that that there is
Okay,
a
you
risk,
go for it. Yes. You
you presume that there is a risk.
presume. Yes.
But if you believe otherwise, you document that it is not relevant in my case. So you
Yes,
start
yes.
with a
As you
presumption. For
said in
example, if I have
rebuttal,
to
you have
give
to put it in
yes,
documentation.
so if I have to compare this Smriti with an accounting concept, right? For example, under Ind AS 23, right, we
Okay.
capitalize interest or we capitalize borrowing cost on a qualifying asset, right? We say generally qualifying asset will take 6 months of constructions, right? Generally, that doesn't mean that it can't be more than 6 months. It can still be more than 6 months. It can even be less than 6 months, right? So you start with a rebuttable presumption. For example, when you look at associate, if you hold 20% investment, it is generally presumed that yes, it is not,
Yes, that is the
it will
criteria to be
always
looked
happen.
into.
Yeah, yeah.
Uh,
So I'm saying it is so the if you don't have any criteria, right, then it is very
hmm.
difficult for an auditor to say that there is a fraud or there is not a fraud.
Okay.
And mind you, these auditing standards in India are not just an Indian invention. They're also very closely connected with the global norms or the global
Global.
standard setters.
Yes, global levels.
So if globally the entire planet in this Milky Way believe that that revenue is the possible area which is susceptible to fraud, it will be very difficult for me to say that no, in India there is one set of part of this entire globe where we believe it differently. It is very, very difficult because we're ultimately connected with the entire global supply chain. It can't be that we will be able to isolate ourselves operationally from the entire globe, right? So I think, and your question is absolutely valid. But just to conclude, we are not saying that in all cases it will be a fraud. But yes, what we're saying generally, we have seen in our experience that it is prone to fraud. If you think it is not there, so be it. So you document and you move on. But the general presumption is that it is susceptible to risk of fraud. Am I clear, Smriti?
Yes, sir. I'm clear, much clearer in a finer way. Thank you.
No problem. Thank you so much.
Thank you so much.
Yeah. Yeah. So that is the entire discussion or the entire logic that we have. It is stemming from SA 240, which talks about presumptive risk of fraud in revenue. Yeah. Okay. So let's move on to the second topic in the discussion of audit planning. Sartaj has another subsidiary, right? It's known as Black Pearl LLC. Now, this is a question under the FEMA norms. Now, under the FEMA Overseas Investment Regulation 2022, Sartaj is required to file an annual performance report with the RBI. So, to expand on this further, if you have an overseas subsidiary, there is a requirement under the Indian RBI norms that you have to file a return called annual performance report, which is basically the audited financial statements of that subsidiary and and certain information that is there in the particular form. So largely it is a financial information driven form, but it's a requirement of the Indian laws and regulation. Now, one of the catch is that this is also a compliance requirement, right? To make further investment. So this is also an RBI's way of monitoring where the fund is going to be has been invested. Is it that it is just a sham entity, or is it that it is actually an operating entity where you have operations? Yep. So that's where it is, and you would gauge that the next question which I'm going to pose is on this particular topic. So let me pose this question. Now, under the FEMA overseas regulation, the surcharge is supposed to obtain audited financial statements. Okay. So again, we have four options, and I want you to choose or respond through chat what could be the appropriate answer. Now, the thing is that is it a mandatory requirement to have an audited financial statements, right, under the APR norms or the RBI norms, or do you think that there is an exception, right? Uh, and again, a caveat, especially for Smriti, the text you might find a bit common or overlapping. So I would urge all of you to read these options very, very carefully before responding, right?
Yes, sir.
So I'll take a pause, and when you guys are done with the responses, we can discuss. So if you would look at the four options, first option is that the filing of APR report is based on audited financial statements of Black Pearl, right? Black Pearl is the LLC. Filing of the second option, the filing of APR can be based only on reviewed financial statements. So it is not audited, but if you are subjecting the financial statements to limited review, that, as per one of the option, is also acceptable as per the FEMA norms. Third is that you can file the annual performance report without audit, without review, because the host or the country where the entity is situated, which is Black Pearl in our example, they don't mandate an audit. So the Sartaj can file the form APR using unaudited management approved financial statements. Fourth option, right? Filing of annual performance report should be based on audited financial statements since it is controlled by Black Pearl. Sorry, it is controlled by Sartaj. So in just for clarity, option 1 and option 4 are quite similar, but option 4 we're trying to add why we think that an audited financial statement is necessary. So it is necessary because we believe that since it is a holding subsidiary relationship, it has to be audited mandatorily. Okay. So do I have some response? Yep. Okay. So I have not got any response. So in the interest of time, let me bring out the answer. So as far as the FEMA norms are concerned, if it is a holding subsidiary relationship, right, then by default, you are controlled, you meaning the subsidiary is controlled by the Indian parent. In that case, the board of directors or the majority of the shareholder will vest with the Indian entity. So it is very easy for the Indian parent to ensure compliance with applicable laws and regulation of India. So in that case, the FEMA norms are very clear to say that if it is a holding subsidiary relationship, then it has to be based on, it has to be audited. There is no exception of auditing, right, for the purpose of filing of annual performance report. That is despite the fact that the uh, jurisdiction in which that subsidiary is operated do not mandate an audit, right? So that's a very clear requirement that is there in the Indian laws and regulation. Yeah, is that okay, everyone? Is it clear? Any confusion? Okay, so thank you, Smriti. Okay, let's move on to the third topic for discussion. And so here I think we have uh, a bit of an accounting requirement and bit of a requirement under Companies Act. So Sartaj has a policy of providing loans to employees. Okay, and they charge 5% annual interest rate. The loan is supposed to be paid at five equal installments. If you would look at the comparable market rate, you are the comparable market rate is 10%. So if an employee of Sartaj has to obtain a loan of which is to be payable in 5 years from a bank, probably they will have to pay 10% interest. But since they are an employee of Sartaj and Sartaj is providing that money, they have a policy to give loan at a subsidized interest rate. So as an employee of Sartaj, you are eligible to have a loan at 5% interest rate. Now, now the question stems around that, right? Let's say there is an employee who has taken a loan of 10 lakhs. Okay, from Sartaj, they have to pay an annual EMI of 2.31 lakhs. Now the question is that from a accounting standard perspective, especially from Ind AS 109, how should this 10 lakhs be recognized in the financial statements? The auditors are actually concerned about the accounting treatment adopted by the entity uh, for the financial statements. So uh, I would like to open the house uh, for this thing, for your responses, and just to gauge your memory, that how do you think that this should be uh, accounted for, right? So just I'll take a pause and I'll then ask every one of you to put down your point of view, right? Okay, so we have four options. The first option, I think we will go to the accounting requirements in a bit. But let's see if I have to talk about compliance with applicable laws and regulations. Now, to jog everyone's memory, we have Companies Act 2013, especially Section 185 of the Companies Act. Now, if you would have given a loan to the to various employees under the Companies Act, the question that is being posed on the slide, that is it first of all permitted under the Companies Act? If yes, is there a particular compliance requirement, or if it is, or is there a scenario where we can give approvals, give loans to employees without any approval? So again, we have four options, and I like all of you to choose out of these four options. Yeah. So first option, if you would see, it is in the context of Section 185 of the Companies Act, right, where the the where we have said that the company should have obtained special resolution under Section 185 of the Companies Act, where uh, and you can only give a loan to an employee if it is uh, if you obtain a special resolution. There is another option which says that Section 185 doesn't cover loans to employees who are not directors. Okay, so anyway, so the option is that we can give it without any approval. Third option is that the Section 185 does not cover loans to employees not being managing director. Section 186 as well do not cover any loans that is given to employees. So again, both from section 185 and section 186, there is no prohibition for giving a loan at a subsidized rate to an employee. Okay. And again, there is a fourth option where we have said that you have to obtain a special resolution, but you have to charge at least the market rate. So the difference between point one or option one and option four is that in option four, we are saying that we can give a loan to employees, but you have to charge market rate and not a concessional rate. So in our example, 10% interest should have been charged and not 5%. So let me ask all of you, uh, what do you think would be the possible response? Any thoughts? Okay. So I think the correct option is option three. Yeah. So if I have to take you back to the requirements under the Companies Act 2013, there are two sections under the Companies Act which deal with uh, giving of loan. First one is section 185. Okay. Now under section 185, it is bifurcated into two parts. One, are those scenarios where you cannot give loans. Okay. For example, you are giving loan to a firm where a director or someone is a member or director or a partner, so that you can't give. Second, you can give loan to a particular set of people or to a particular set of entities if you obtain certain approvals. For example, you obtain a special resolution of the shareholders. There is a third category, and where it gives kind of an exception, right? That if you are giving a loan to an employee, okay, who is not a managing director or a or a director, in that case, uh, you are not supposed to be covered under section 185. Okay. So as I said, in the fact pattern, it is an employee who is not a director. So as far as section 185 is concerned, you are outside the ambit of section 185. So if that employee would have been a director, for example, and a managing director, then possibly you would need to look at compliance under section 185 before you have given a loan. But here, since the individual is an employee who is not a director, the compliance with section 185 is not triggered. Okay. Now let's talk about the second section, which is section 186. Now 186 talks about charging of interest. Right? In that case, section 186, it prescribes a minimum rate of interest. It says that whatever is the government yield, right, for a corresponding tenure of the loan, 1 year, 3 year, 5 year, 10 year, that is the minimum rate of interest an entity should always charge. Okay. But again, for a loan given to an employee by the entity, there is again an exception. Right? So those even from a minimum interest perspective, section 186 doesn't cover any individual who is an employment of the company. And for your benefit, I think we have tried to put down the requirements of section 185 and 186 on this slide. So in a nutshell, if you are giving a loan to an employee who is not a director, then you are free to give, because there are exceptions available under section 185 and 186 both. Right? So is it clear, or is there any confusion, any experience? Happy to hear. Yeah. So thank you, Smriti. I think, is there any other thing? We have Devabrata, we have Resham, we have Priyanka, we have Rajiva. Any confusion on particular topic? Do let me know. Yeah. I hope it is clear from our discussions.
It is clear, sir.
Yeah. Thank you, Smriti. Okay. Now let's come to my favorite question about accounting. How would you account for this loan, right? So you have given a loan, right? Just to jog your memory, we have a loan uh, of 10 lakhs. We have charged 5% interest, whereas the market rate is 10%. So if I have to go take you back to Ind AS 109, they are very clear that a financial asset has to be recognized at a particular way, right? So what they would require is that they would require you to fair value the loan, right? Using the interest rate of 10%, which is the market rate, right? You find out the present value. The difference is what you recognize as an asset. So in our example, we'll pay a we'll have a recovery of 2.31, which will be principal plus interest. I'll try to fair value that and recognize a financial asset in my financial statements. So let's say, how will we recognize that? So in the slide, you can see the present value rate. You can see the cash flows. Over a period of time, I will get 11.51. I will do a fair value based on the discount rate of 10% and find out a PV every year. Now, difference between my cash flow and the present value is what I would call as prepaid staff expense. So in our example, we would recognize the financial asset, right, at 8.76 lakhs, because that is what is the present value, right? So I will debit asset, present value. I will have a prepaid staff expense, which will again be an asset side. And then I will also have a corresponding liability. Now, over a period of time, I will charge interest of 10% and I will increase an amount of liability. The prepaid staff expense over will be then amortized over the tenure of the loan. So in a nutshell, if I have to simply put, right, they go very clearly by the fair value concept. It is not the transactional price unless it is fair value, right? So in this scenario, I think it is very clear that instead of charging interest at 10%, the entity is charging a 5% interest. So as far as the accounting phenomena is concerned, especially in AS 109, it is assumed that this differential interest is nothing but a staff or employee benefit expense. That I am getting this benefit or a subsidized interest I am getting only because of an employer-employee relationship, right? So that is the reason for me to say that this difference is nothing but an employee benefit expense, which I will amortize over a period of the loan. So very similar to the fair value of loans that we will do in the normal course, right? Okay, let's move on to another question. Now, we have talked about the planning meeting. So another topic which had come up for during the meeting is a possible disclosure which the board of directors was supposed to make in the board's report. So under the Companies Act 2013, there is a very clear reporting requirement by the board of directors about the compensation that is being paid to various board members. So if you would see, you can see the percentage increase of remuneration as compared to last year. What is the median amount of ratio of remuneration? And this disclosure has to be given director wise, right? So if you would look at here, there are specific footnotes. For example, you have given the percentage increase over the past 6 years as 5%. What has been the annual percentile increase, based on various salaries that has been given to the MD, CFO, and senior uh, personnel. The disclosure is also supposed to affirm whether these are as per the remuneration policy of the company. So, all that disclosure the entity is proposing to give in the board report. So, now in this fact pattern, let's see what is the question. The question is that which of the following information is not in line with Section 197 of the Companies Act? Section 197, as we all know, is a section which talks about remuneration that is being given to managers and directors, right? There are also corresponding rules, which is appointment of a remuneration and managerial person. So again, we have one, two, three, four, five, six options, and then we have to choose out of these six options uh, what is not in line. So I know it might be a bit difficult because the fact pattern is on the other slide, but just for your reference, I'll switch back and put the fact pattern. So if you guys find in any inaccuracy or anything that is inaccurate or it does not require a disclosure, that is what we are looking at. So the idea is to spot the error. What is it? What you think is erroneous in your point of view in this disclosure to be made? Any thoughts, anyone? Any thoughts, Jayabhrata, Resham, Priyanka?
The percentage increase.
Okay. So you're talking about the second option, Smriti? Is it second or the third or the fourth? Okay. So we have couple of errors. So we have one, we have two, we have three. So I think these are what is not correct. So let's see what is not correct. Okay. Now, as far as the disclosure is concerned, this is supposed to be disclosed for the number of permanent employees and not just all the employees. So again, I think they have disclosed the number of all employees. The percentage uh, increase in the median remuneration should be provided for the entire financial year, not just 6 months. Again, percentage increase of directors is correctly disclosed. Percentage increase in remuneration of company secretary should also have been disclosed. Uh, the ratio of remuneration of CFO to the median of employees is not required to be disclosed, so that's an additional disclosure. And lastly, the affirmation is in line with the remuneration policy. So a couple of hits and couple of misses. So maybe when you go back, you can also have a relook at what are the disclosure requirements under the under the Companies Act as far as the remuneration for the board and the senior members are concerned. Right. So again, it's a very prescriptive kind of a requirement. If you would look at that particular section as well as the rules, they would lay down what is the expectation, what is to be disclosed, and what are those additional disclosures that the entity has proposed. Okay, so now let's come to the other part. We have talked about accounting, we have talked about auditing. Let's talk about strategic decision making. So now there would be too much facts that I'm going to tell you, but I think the idea is to have certain reactions when we go through a particular fact or a particular scenario as far as the decision making is concerned. So we have 3 or 4 slides which will talk about certain facts about this entity. So, for example, as we know, Sartaj, it's a hotel, and they one of the very important item that they have in their possession is food and beverages, which is perishable, right? So now to maintain inventory and not to have inventory obsolescence, they have a very strict mechanism to monitor inventory. As far as food sourcing is concerned, they follow two particular approach: push production and pull production. Push production is basically where services have been offered, uh, but uh, uh, but they have not been paid in advance, right? And there are pull productions where there are conferences, fixed events. They have been reserved in advance, and then as and when the activity happens, the services and the inventory would be provided to the individual uh, person. So that's how they operate. Now we talked about food, and food comes from the hotel menu. As far as Sartaj is concerned, the head chef is the creator of the menu. Head chef very categorically monitors the entire menu, and it is very important for the head chef to keep the the menu to be more recent and more contemporary, because the head chef also takes into account the shift of customers' taste and customer preferences, and they update the menu quite frequently. Now, the moment they update the menu, there is also a corresponding change in the inventory management, right? That is also updated. Now, and since this is based on a very personalized experience, one of the important judgment area for the chef is to guess what could be my change in customer preferences. So that again comes with a very deep experience in a particular sector and a particular service to a set of clientele. So net in this slide, what we try to say is that the head chef is the creator, memory, and the processor for menu setting of Sartaj, which then have a consequential effect on the entire inventory sourcing as well as inventory management. Next is that the entity also collaborate with suppliers in a very close uh, manner. Now, the Sartaj food service outlets, they leverage fresh produce. They have supplier partnerships, and they have very clear identified vendors. And since it's a service driven industry, there is a very close relationship between the chefs and the supplier. They know each other quite well. They understand the need for a high quality ingredient, and since they want to offer a very personalized and high quality service, the food and beverage items are handpicked by the chefs, right? Cost, whenever they are trying to buy a particular item, uh, cost or lower cost is not always the deciding factor, right? They would give quality of the produce to be far superior as compared to the lower pricing of the product. Okay. The entity has also tried to have a two supplier strategy. For example, if one supplier is not able to provide us with the required goods, so in that case, they might have to go to a different supplier. But it has worked in certain of them, but in some they have not worked. But ultimately, they're also all still trying to uh, see what could be the alternate suppliers. Use of technology. So I think we talked about guessing game where it is based on an individual judgment, but I think the entity is also trying to streamline and look at minimal uh, uh, human intervention. They are using multiple data points to to find out the eating pattern, and so as to have a much more clear cut inventory management, because it could be very well possible that the chef would have guessed the customer preference in a particular way, but that's how it may not have ultimately came out to be. So wherever you use technology, and we could say from our experience, the technology has a very strong possibility to look at loads and loads of data. They will churn out various analysis, and they can always predict what could be your possible inventory consumption. So again, they are trying to replace guessing game of chefs with more objective data driven points. There are also in-house activities, right? They are also trying to have significant investments in infrastructure, equipment, and skilled uh, labor. This is one of the ways to rationalize cost. If you have an internal supplier or an internal skill, then you don't have to pay a premium for for having external services. This is especially true because the cost of people are on the rise. So sourcing people or talent outside the firm is proving to be very expensive. So now let's see what could be the current weaknesses and recommendations. So I know this is a more of of a descriptive kind of a question, and this would require a very twice or thrice reading of the particular fact pattern. So what I have done is that I have tried to lay down certain facts and certain observation which I had personally, and then I would like to open it out to everyone if I have missed out on on any particular aspect. So as far as the current weakness of the entity is concerned, if you would look at fact pattern, the demand forecasting and the guessing game or the common sense knowledge of the chefs, I think is what has to go, right? It has to be more data driven. It has to be more objective data analysis and data tracking, so that it is a more clear cut inventory supply chain, right? So at present, the chefs may not be looking at the possible historical trends, and they must be using their own minds to look at the weaknesses. So something that they should have uh, corrected. Okay, so again, there is a high, another weakness is there's a high job mobility of chefs, and we have also seen there are retention issues, right? That's probably something which they would need to fix. Again, technology absorption, as we saw that even the basic or the fundamental things of tracking inventory is not automated. So probably the integration of technology is very less. And there is obviously a manual, intervention. So again, a low use of technology is an area of weakness. Uh, a recommendation. will obviously be to have a much more data driven kind of a decision making. It is not that forecasting will be based on judgment or individual preference, but based on typical data. Knowledge retention. Now, whenever, even though we mix objective data with chefs, we should be able to formalize the knowledge management system of you would appreciate that if let's say a new chef comes in and the previous chef has retired or left the organization, then the entire knowledge base goes with that person. So it is very important that we formalize, we document, as in as it and it is true for us also as auditors, where we document our basis or our rationale. So he might be using his own criteria, and there is always a risk of loss of that information or knowledge if that person changes. So to have a much more formalized structure where we can document and retain these judgment areas is important for Sartaj. Needless to say, increased use of technology, more real-time ordering rather than going and handpicking it from market. Possibly they can also look at automating the entire supply chain. So this will not just help the entity, but will develop an entire ecosystem which will be beneficial not only for the entity but for other suppliers as well. Yeah. So I think in a nutshell, if I have to say that they have to significantly use technology, okay, and leverage data and demand forecasting, which are possibly their main area of weakness. Now, if you address this, they would surely enhance supply chain and they will reduce operational cost. Uh, and again, this will again be a very, very clear differentiator for the entity as a whole. Overall, it will strengthen its positioning in the entire hospitality industry and it will continue to maintain itself as a leader. So I think that's where we would like to take a pause and we'll take a break also. It is 7:50 in my watch. Uh, so maybe we can quickly take a 10-minute break and then we can resume at 8 o'clock. Is that fine with everyone?
Yes, please, sir.
Okay. So we'll resume at 8. Okay. So I uh, would hope that we have some interesting discussions in the previous one, and I would encourage all of you to uh, participate wholeheartedly. I didn't hear from a couple of participants, so I would urge all of them to really, participate and ask for any clarifications that they would need. Yep. So in this particular question or fact pattern, we would follow the same manner that we had used in the previous fact pattern. But this, I think, is a much more new age kind of a um, sector. It is evolving. So we felt that this could be a very interesting perspective to look at emerging new age, but very promising uh, sector, right? So I don't know how many of you are gamers or like to play online games, but I can tell you from my experience with my son, I think the whole world of online gaming is just starting, right? So you will always find some or the other new games that is coming up, uh, you know, online. So that was on a more of a personal note, but let's start with the fact pattern. We're talking about Fastest Finger Limited. It is right now an unlisted company. It is founded by an individual called Mr. Viper, right? And he has embarked on a mission to to uh, enhance India's footing on the global gaming landscape. Now, if I have to then split this up, we have two separate segments. One is gaming and one is esports, right? And there is again organic or inorganic growth. So they somehow, they somehow kind of fuel the overall growth of fastest finger, right? Now, as you would all appreciate that the online gaming platform is always agile. There is all something or the other new technology which would come up, right? So there is a need to always refresh our existing database of games, put in new experiences. Probably you will have different kind of a complexities. Similarly, it is in the esport segment where as far as the fastest finger first is concerned, they are filling a bit of a non-linear EBITDA, right? They are trying to consolidate and be a leader in the esport segment. But both they believe is quite promising. If I have to give a bit more detail about the games that the entity have, so they have four kind of offerings. They have Chak De India, they have Teen Patti, they have Z Sports, and they have Nox A. So if you would read on this slide, uh, they Chak De India is a cricket game simulation. It is used by 1.5 million daily active users with 9 million active users on a monthly basis. Revenue has also grown by 7%. Last year it was 10%. As far as Teen Patti, I think we all know we play this quite often in Diwali or in some festive occasion, or we have a family gathering. It's a classic card game. It is a premium offering by the Fastest Finger First Limited. Revenue had not been that great as compared to last year. So last year the revenue grew by 12.5. This year the revenue grew by 8%. Now in this particular game, they are also trying to further strengthen its position. Now there is a third or a promising kind of a dimension. They have it is called Z Sport. So it is not like one type of game, but it's a multi-sport destination. It is becoming very promising. The entity or this particular game is is having a dominant position in key markets. Revenue has also not been that great. If you would say 25% last year, in the current year, it is 12%. But there is a very strong customer loyalty to Z Sports. The customers have actually liked the overall uh, addition to the game, right? Um, so Nox A, there's a new type of game simulations which they're trying to experiment. It is an innovative game, and it is a very new age or an introductory kind of a game. As far as fastest finger first is concerned, they believe that other companies will also join in this type of games in the near future. So net Chakde, Tinpatti, Z Sports, and Noxe are the four broad categories of offerings which Fastest Limited has to offer. Okay, so let's talk about the entity a bit more detail. Now, if you would look at Mr. Viper, he is the CEO and he is actually concerned about the future prospects of FFL or Future First. It is not that they have any going concern issue, but he is actually concerned about the overall vision of the entity, right? Probably there is no one vision. Everybody is trying to look at different objectives. There is no one unified vision of the firm. Uh, so he felt that the entity is suffering from strategic drift and has no clear vision about its purpose and direction. It is still a dominant force in the industry. It is very active in international and local market, but it has started to lose its dominance. Uh, they are also planning to have more and more investment in promoting foreign revenues. Now, one of the key concern, right, which they have is Teen Patti, right? It is a premium online game and it is also provided in major theme parks, right? They the entity Fastest Finger had a 5-year contract which was due to end in the next year. Although they are very confident that the contract would be renewed, but they are seeing a reduction of the offtake of this particular game, right? The entities, especially Mr. Viper, believes that the customer may switch its business to a large competitor. So even though there is a renewal of the contract, but the CEO believes that there could be slowly and steadily loss of revenue, which might be as good as losing 10% of profits, right? And this will also then have have a redundancy in the workforce of the entity. Okay, so now to do all that, now Fastest Finger is in the process of getting listed, and and uh, uh, and uh, they under the Companies Act they would require it to prepare its financial statements under Ind AS. So in the current year, which is March 24, in our example, will be the first set of financial statements that they would prepare under Ind AS. Now, under Ind AS 101, which is the first time adoption of Ind AS, you were supposed to present 3 balance sheets, which is March 24, March 23 as the comparative period, and opening balance sheet as 1st April 22. Right? There are obviously implementation challenges because you are supposed to recast all the 3 years numbers as per Ind AS. So again, there is a transition challenge and there is a challenge on how to compute these numbers. So with this, I will pose the first question on this topic. And we have started with a very simple kind of a question. What is the date of transition of Ind AS for the Fastest Finger? Is it 31st March 24? It is which is the year end. Is it 1st April 23? right, which is the beginning of the current year, or is it March 23, which is the year end of last year, or is it 1st April 22, that is the beginning of the previous year? So, why is it important to have the clarity on the transition date? Because that is when you choose the transition options. And we'll come to that aspect also, that what are the transition options the entity has chosen. But for the clarity of everyone, transition options are certain relaxations which the standard permits when you are transitioning, when you're changing from the previous gap to Ind AS. There are certain exceptions or practical wayouts or workarounds which the standard permits, right? So again, with this, I will pause and open the house for response. So Geeta, Resham, Jayakrishnan, Smriti, Rajiva, what's your view on the transition date? What is the appropriate transition date for fastest finger? Any thoughts, anyone? Is it 31st of March 24, 1st April 23, 31st March 23, or 1st April 22? Okay. Any guesses? Okay. So let me bring out the answer. The answer is 1st April 22. So if I have to clarify, uh, 1st April 23. Okay. Jayakrishna, why do you think it is 1st April 23? If I can ask. Okay. So as far as Ind AS 101 is concerned, Ind AS 101 deals with the first time adoption of Ind AS. So if you would visualize a financial statements, normal financial statements, you would have the current year, which in our example is 31st of March 24. You are supposed to give comparatives, which is 31st of March 23. So that is, you would anyway prepare two columnar financial statements. But in the comparative period of 22 23, right, you have opening retained earnings, which is 1st April 22. That's the that's the most previous number or the most old number that you have in the financial statements, right? So what Ind AS 101 says is, if that is the starting point, right, for the financial statements of current year, you tell me what that is the date from when you should change your accounting. You should change from previous gap, which is AS in this scenario, to Ind AS. So you change from the first period presented on the financial statement, or the first date presented on the financial statements. So in this scenario, first date is 1st April 22. So if I repeat, in my current year's financial statement 23-24, I have a comparative period 22-23. So 1st April 22 is the starting date in my financial statements of the current year. That is also the date when I will prepare a third balance sheet. Okay, so I will have when I'm applying Ind AS 101, I will have three columns in my financial state or in my balance sheet, right? So that's the first date that is there in my financial statements. As far Ind AS 101 is concerned, that is known as the transition date. Okay, that's the date when you are changing your accounting norms. Right? Is it clear, everyone? Some confusion? Somebody wants to discuss something?
No, clear, sir.
Yeah. Okay. So now let's move to a follow-on fact pattern. Now, when we are talking about transitioning, right, uh, on the transition date, which, as we said, is 1st April 22. Now, as I said, on 1st April 22, you are permitted to choose certain relaxations. In a very technical way, they call it exception or exemptions, right? So let's say if you would have followed a particular way of accounting your property, plant, and equipment, then Ind AS 101 permits that whatever is the net carrying value of the property, plant, and equipment as per previous GAAP, that can be carried forward as a valid Ind AS amount on 1st April 22, that is on the transition date. So if this transition option would not have been available, then I would have to recast my property, plant, and equipment accounting right from the day of incorporation. Right? I would have to dig out all those previous records and recompute that if I would have followed Ind AS from day one of my incorporation, then what would have been the net carrying value of property, plant, and equipment. So instead of doing a very rigorous or onerous exercise, the standard provides you a practical expedient or a relaxation. They permit that whatever is the value that you have recognized as per the previous GAAP, that can very well be considered as my opening date amount, right? And this is an option that they give, right? They say that this is an option which you may choose to adopt. So again, as we discussed earlier, it is an option. It is not mandatory. They might choose to even say that, no, I will rework from day one. What would have been the balance that they're free to do. Similarly, there is another option that they can exercise, which is like property, plant, and equipment. If there had been a previous amalgamations or merger, I would have accounted for under AS 14. Okay. If I would have followed Ind AS on that year, right, what would have been the balance? So again, this is a practical expedient or a practical way out, which the standard permits to say that uh, the values of a business combination or an amalgamation that would have recognized in the past can very well be considered uh, uh, in the current year on the date of transition, and you don't need to rework the values of those past business combinations. So in both this relaxation or exemption, you are permitted to carry forward those previous gap balances on the date of transition. You don't need to rework, right? So again, both of them are options which the entity may or may not choose to adopt. Okay, so now let's go to the question that we had, which is this. Now, if I have to compare this with IFRS 1, because I think in our subject, we are also supposed to understand the difference between Indian accounting standards, Ind AS, as well as corresponding accounting standards internationally, which is IFRS. We have Ind AS 101. Internationally, we have IFRS 1. Now, if I compare Ind AS 101 versus IFRS 1, the question is that whether IFRS 1 also permit similar relaxation as far as the property, plant, and equipment is concerned. So as we said that we discussed earlier that the previous GAAP value of property, plant, and equipment is permitted to be carried forward on the date of transition under Ind AS 101. So now the question is that whether similar exception is available under IFRS 1. Okay. So again, I will take a pause and I will request all of you to put forward your responses. So anyone would like to put their response on the chat or make a wild guess? Okay, so let me bring you the answer. Okay, we have one response. Okay, and let me see who that person is. Oh, Priyanka. Priyanka believes that it is option two. Okay, so Priyanka, you believe that unlike IFRS 1, Ind AS 101 provides an additional option. So what you're basically saying is that this option which is there under Ind AS 101 is not available under IFRS 1. Is my understanding right, Priyanka?
Yes, sir.
Okay, okay, good, good. And you're absolutely right. So Ind AS 101, when Indian standard setters, the Ministry of Corporate Affairs, uh, tried to converge with IFRS, okay, they felt that there could be certain India specific considerations. So one of them is this property, plant, and equipment exception, which they felt is very relevant from an Indian standpoint. So they brought out few differences between the international standard and as well as the Indian standards. In technical world, they are called carve outs or carve-ins. Carve outs meaning when you are deviating, when you are when you are deviating from a particular requirement under the international gap. So international gap doesn't permit this option, but we have included this option. So we are deviating from a specific prohibition under the international standards. We also have carve ins, meaning where the international gap is silent or any IFRS or IAS internationally is silent. We are proposing an additional guidance from an Indian standpoint. Business combination, common control business combination is one such, carve in where India, Indian standard setters have developed something which is not available internationally. So again, a very jurisdiction specific consideration, which is applied generally when you transition from a previous gap to Indes or a different standard. So Priyanka, you are absolutely right. This particular exception is not available under IFRS 1, and this is an additional option which is available under Indes 101. Famously, this is known as paragraph D7AA of Ind AS 101, which provides an added transitional relief from retrospective application of Ind AS 16. Okay, so again, whatever you have recognized validly as per the previous gap, you are permitted to carry forward those balances. But I want to put you give one caution. uh, when you are transitioning from a previous gap to Ind AS, the assumption or the expectation is that the previous gap values have been computed correctly as per applicable gap. So when you are transitioning, you identify an error that you would have committed in the previous gap. Then there are certain disclosures that are required to be presented. So net, if I have a net block of rupees 100 and I have a 10 rupee error, I can only carry forward 90, right? That 10 has to be written off and disclosed in a particular way, right? So what I'm trying to caution you is that even though this permits a transition, this only permits you if the previous gap balances are in line with the applicable gap. If it is not correct, then you have to do certain adjustments. Yep. Okay. Now, second accounting question is that the CFO uh, also mentioned at the time of transition that the entity had invested in certain uh, investments in Dream Play Limited. So these are convertible debt instruments. Now, under the previous gap or under AS, these were considered as investments, right? And accordingly, Dream Play Limited was neither considered to be a subsidiary, associate, or a joint venture under AS. So, if you would recall, under AS 18 or AS 21, which talks about consolidation, it would generally talk about ownership of share capital. So, since these are debt instruments, those were the investments in those through those instruments did not yield any control relationship with those entities. Accordingly, those entities were not considered or neither considered as subsidiary or an associate or a joint venture, right? However, when I apply Ind AS, we go more substance over form, right? We say that there is a substantive right, uh, and when these debt instruments would be converted into equity, right, I would be able to exercise control. So under Ind AS 110, they are considered as subsidiaries. So assume that I have a transition date of 1st April 22, and at the time of transition, when I'm transitioning from AS 21 to Ind AS 110, I find out an entity which was never consolidated in the past. So the question is, what should I do in that scenario? Is there a particular exception which the uh, which Ind AS 101 uh, allows? So any thoughts, anyone? Is there a possibility to not adjust previous year's balances on account of Ind AS? So net the question is that can I stop or can I not consolidate uh, Dream Play Limited when I'm transitioning from Ind AS, because I have never prepared a consolidated financial statements because there was no component, neither associate, subsidiary, or JV. So can I take that view even when I'm transitioning to Ind AS on the date of transition? Yeah. So again, I will take a pause and I will request any response from anyone. So anything rings a bell that is there a transition option that is available on the time of transition uh, to stop from retrospective recomputation? So if I have to take you back to few facts, right, that is what I think we saw here. I would like you to focus on the last bullet. The entity has chosen not to restate previous year's business combination. So that is a transition option that is available. Now the question is that if there is a transition option that is available where I don't have to recast my previous year's numbers, what should I do on the date of transition, right? So let's go back to the question. So uh, I can understand that this could be a bit of a complicated or a complex question. So let me break this down to two or three things. One, there is an exception available. I don't have to recast or recompute my business combination as per the uh, previous gap. Okay, so Ind AS 101 acknowledges this complexity, and I would like you to focus on the first two bullets in blue, and I will read out for everybody's benefit. There is appendix under Ind AS 101, appendix C, which states that if past business combinations are not restated, right? So that's the first condition. Here, the entity has chosen not to restate past business combinations, right? Because they're saying that we will carry forward whatever we did last year. And the entity has not prepared a CFS, right? So, what I would like both of you to note is that this is an and condition. One, I have chosen not to restate, and I have never prepared CFS in the past, right? Then what happens? Then the assets and liabilities of the subsidiary, which is Dreamplay, would be included in the parent's opening consolidated financial statements, which is basically my date of transition, as would appear in the subsidiary's separate financial statements. So, if I have to simply put, if there is a net asset of 100 in the books of subsidiary, which I have not consolidated because I was not required to consolidate as per previous gap, then this 100 rupees would now be recognized in my opening balance sheet on the date of transition. But again, I would also like you to caution you that when this accounting is proposed, these are only permitted where, in accordance with the previous gap, consolidated financial statements have not been prepared. Right? So again, this is a very narrow exception. It is not a very easily available exception. But yes, if you fall in this narrow category, then possibly you can avail this exception. Yeah. So that's what it says basically. So what will happen in this present case? I will take the value of assets and liabilities as is appearing in the standalone financial statements of the subsidiary, and I will recognize on the transition date. Right. So that's what I am supposed to follow. I will take a pause here. I know that it is a complex or a complicated topic, and I want to give some um time for you guys to absorb. So let me know. Maybe we'll take a minute or two to if you want me to repeat or if there is a confusion.
So can you repeat it?
Sure, Shraddha. So, okay. So I will again go back here. We are talking about a scenario where I had a investment in Dreamplay Limited. I did not consolidate because as per AS 21, that entity was neither a subsidiary, associate, or a JV. So I never consolidated, and hence I only prepared standalone financial statements. I didn't prepare consolidated financial statements. Now I am transitioning from 1st April 22 from AS to Ind AS. Now the question is that how should I include the value of assets and liabilities of that entity in Dreamplay in my consolidated financial statements? Why? Because under Ind AS, that entity is considered to be a subsidiary. Okay. So it is a first time that I am preparing a CFS. So what the Ind AS 101 says that in that scenario where you have never prepared a CFS, since you are not required to prepare a CFS, and you have chosen on the date of transition not to restate previous year's transaction, then On the date of transition, you pick up the value of assets and liabilities appearing in the standalone financial statements of the subsidiary and include that in my opening retained earnings. So let's say I have on the date of transition the value of rupees 100 in the standalone financial statements of the subsidiary. I would use that value. I will debit assets and credit equity in the financial statements, in the consolidated financial statements of or of Fastest Finger First. Is it clear, Smriti?
Yes, sir.
Yeah. I know it is a bit of a complicated or a difficult scenario, so I am trying to spend some time and avoid any confusion which you might have. So again, I am requesting everyone, if there's a confusion on this particular question, do stop me or let me know what you would like me to clarify. Yep. Okay. Now let's take another question. And now from accounting, we move to GST. Uh, uh, Now the online gaming have been a bone of contention with the GST laws and regulation and GST officials. If we would look at the press, there had been a significant amount of debate about what is the amount or what is the rate on which the GST should be computed. And there is also a discussion on what is the amount on which GST should be computed. So let's say as far as Fastest Finger First is concerned, the CFO mentioned that during the year, the entity has received 35 crores, right? And out of this 35 crores, there were certain unused balances of 4 crores, and there was 1 crore of refunds. So somebody put some money in the wallet, and then they again have to refund back. So net 30 crores is what the entity would have used or earned as its revenue from providing online gaming service. Uh, and 30 crore is the amount on which they have computed the amount of GST. That is fact number one. Another, yes, Yug. Yes, Yug, I think you raised your hand. You had some question? Okay. Uh, we have another fact to add, that in addition to the way we are saying in bullet 1, where they have computed the amount of GST, they have also received a demand come show cause notice alleging that the entity has not paid 50 crores of GST, uh, which relates to previous year. The entity has also filed an appeal on March 24. So they are disputing this 50 crores of demand. Right? So with this fact pattern and context, let's move to the question that I have. What do you think is the amount of GST that they should have paid on the first question that I have asked, right? So they have received 30 crores and then they have refunded 5 crores. Uh, so how much is the GST liability that the entity should have paid? Is it 5.81, 11.3, 9.8, or 30.11 crores? Yeah. So again, I will wait for you guys to respond in a minute or two.
So 9.8 crores.
Okay. Okay. Anyone else? Any other thought? So Spriti, let me ask, why not 5.81?
So on 35 crore, 28% will be charged.
But I have not earned 35 crores of revenue, right? I have only earned 30 crores because I have to refund 5 crores. So why should I pay GST on some money which I have not earned as revenue?
Whatever amount you won, that on that amount we have to pay the GST.
Okay. So basically you are saying it is not linked with how much have I earned. It is dependent on how much I have received.
Yes, sir.
Yeah.
Yeah.
Okay. So I think Smriti, you are absolutely right. So it is 9.80 crores as the amount of GST that you would need to pay. Now, what I would like to draw everybody's is attention is Rule 31B of CGST Rules 2017, which basically reiterates the fact that even though amounts have been returned or refunded, that amount would also be subjected to GST of 28%. So the rate on online gaming from effective 1st October is 28%, and the entire amount of receipt, which is 35 crores, would be subjected to GST. So 35 crores into 28% is 9.8 crores. So net, it is, as I think Smriti also mentioned, it is not linked with the amount of revenue, but it is linked with the amount of receipt of money, yeah, through online gaming. Okay. Now we also talked about a demand and show cause notice, right? And we all know that as far as Caro 2020 is concerned, these are supposed to be disclosed in the audit report, especially the fact that if the entity has disputed. So to recap, the we have received a demand of 50 crores and the entity has filed an appeal, right? And this is the disclosure that they are proposing. So they are saying they are disclosing, they meaning the auditors are disclosing the nature of statute, the nature of dues, and the amount that is demanded, right? So in this context, if I have to go to the next question, is do you think there is something missing in reporting under Caro 2020? Do you think that the reporting that they made under Caro is appropriate? So again, if you there are only three columns: the name of statute, the nature of dues, and the amount. And you have four options. So I'll again request your response, which is the correct option that you would like to exercise. Do you think reporting is appropriate? So you have first two options as reporting appropriate. You have next two as reporting not appropriate, and there are reasons that has been stated on this slide.
No, sir, reporting is not appropriate because auditor is also report the period to which the amount relates and
Okay,
forum where.
so it's option three, is it, Smriti, according to you?
Yes, sir.
Okay. 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 Any other the thoughts? Rajiva, Devabrat, I didn't hear from you at all. Resham, Geeta. Rajiva believes it's appropriate. Okay. So Rajiva, which one option is that? Is the first one or second one? Which option you want to choose? Okay, till the time he responds. Anyone else? Geeta, Devabrat, Resham. Rajiv wants to choose option two. Okay. Anybody else? Okay, so I think the correct response is option three, which is the fact that the reporting is incomplete because, as Smriti rightly mentioned, the period and the forum where the dispute is pending is not mentioned. So, to have a quick recap, under Caro 2020, the auditor is required to state if there are any disputed statutory due. So GST is a statutory due because it is payable under a particular statute. And if there is a dispute, in our case, there is a dispute because we have filed for an appeal. And in that case, there is specific information that has to be disclosed in the audit report. So in this case, if I have to take you back to the fact pattern, sorry. Yeah, they have only mentioned, the auditor has only mentioned these three items. They have not mentioned which forum this dispute is pending and what is the period, right? So again, that is a minimum information which you are supposed to state in the audit report. Okay, let's go to another question which now relates to Companies Act 2013. I'm sorry. Okay. Now, if you would see there, the company is planning to have a meeting with the board of directors, and Mr. Viper is planning to attend that board meeting through a video conference. Other directors will attend the board meeting physically, right? So again, there are questions that Mr. Viper, who is the CEO, believes that the approval of financial statements cannot be done electronically. All the directors have to be present in a physical meeting. So again, we have four options. Uh, uh, and I want you again to respond what is the correct option according to all of you. One is that people believe that what Mr. Viper is saying is incorrect, because if there is a physical quorum, then the Companies Act permits you to have a board meeting where the accounts can be approved by a direct where the accounts can be approved through electronic medium as well. Now somebody can say that we partially agree that since there is a physical quorum, uh, they can participate in the board meeting, but they cannot approve, right? Another view could be that it is a complete prohibition, that you cannot uh, approve the financial statements through electronic mode at all, right? Or there could be the last option, that the concerns of Mr. Viper is incorrect, because there is no prohibition at all, right? They can do whatever they want. So the difference between option 1 and option 4 is that option 1 is permitted with a specific condition, that there has to be a physical quorum. In option 4, we are saying that there is no safeguard, or there is no additional compliance. So what is the option that you guys want to choose? Is it 1, 2, 3, or 4? Any thoughts, anyone? Okay, I have responses. Let me see. So Rajiva is option 1. Option 2, okay, is Resham and Devabrat. So we have majority towards option 2. Okay. Anybody else? Geeta?
Yes, sir. 2.
Okay. So we have 3 people have a view of option 2. Okay. So unfortunately, option 1 is the correct response. And if you would go to the meeting of board of directors rule, there is a specific kind of a permission that if there is a physical quorum, then the approval of the accounts can happen through audio or video conferencing. What I also want you to note is that this prohibition evolved at the time of COVID, right? Where there were significant difficulty in having a physical meeting. So in that scenario, the ministry somehow came up with a relaxation, and so though it was a temporary relaxation, after that it was introduced as a permanent exception in the Companies Act 2013. So to net sum up, if you have a physical quorum, uh, and in that case, the approval of accounts can also happen through electronic means. Yeah. Now let's talk about the manner in which the board meeting should happen. Uh, so generally, and it's a long response, so I thought I'll put out the responses and I will get everybody's feedback if I missed out something. So it is a stepwise process which is there under the Companies Act 2013 and the meeting of Board of Directors rule. First, it starts with a roll call. Okay, so at the commencement of the meeting, the chairperson will take a roll call when every directors that is participating through electronic means shall state on record uh, their presence, the name, location where they're participating, and they will also reconfirm whether they have received all the agenda of the meeting. Step 2 is for the chairman or the company secretary. He would now then read out the names of the person other than those who are physically present to assist and guide the proceedings of the board meeting. The attendance register shall also be deemed to have been signed by the directors who have participated through electronic means, and it will again be recorded by the secretary. So it's a roll call, and then they will acknowledge their presence as well by the company secretary. Third, they will check whether the quorum is met. So quorum, as we know, there is a specific requirement under the Companies Act 2013 to have a quorum, right, where a minimum of the directors have to be present for a particular discussion. Now, just to clarify to everyone, the entity could have a stricter quorum in the Articles of Association. So under the Companies Act 2013, they prescribe a minimum quorum, but if the governing documents of the entity is stricter, then the entity is supposed to follow that stricter norm. So step 3, the chairperson or the company secretary would confirm that the required quorum is present. If there in a statutory register, for example, shareholding uh, a register or the register of charges that has to be stated or presented in the board meeting, that would also need to be presented, right? Step 4, they would start discussing the transaction during the meeting. The company secretary would state each and every item to be taken on the agenda. They will open the house for discussion if and they will look for an approval or a dissent. Now, if a motion is objected, it will again put to a vote, and the shareholder will call for again a person who would be vote in favor or would register his dissent. And after that, then the chairperson would announce the decision, and that would be taken on record, right? Okay. Now let's move to another uh, question. And this, I think, would again take us back to a strategic management type question. I think we spoke of the business of the entity. We saw that the business is reducing. The CEO, Mr. Viper, has significant concerns about the way the business is happening. there is a reduction of their premium product. For example, Teen Patti, the growth had not been significant. Yeah, and they also believe that there will be a loss of customer, even though the contract for Teen Patti in a gaming arcade would be renewed. Uh, the CEO also felt that based on discussions, there have been there is a need to engage with more people, and they would need to innovate from an online gaming experience. They would need to invest significantly on the gaming experience, and this would require a substantial capital involvement. Okay, and the entity is also concerned that possibly they may not have such amount of funding. Now, they also see a growing dissent within the uh, employees of the entity. They are disaggregated. They are not trying to reach to a consensus on the strategic vision, and some colleagues have very strong disagreement with the overall vision of the entity. As far as the relationship with staff is concerned, it is uh, it is deteriorating. There many people have resigned, or they are unhappy or disgruntled with the way the entity is functioning, and they and that is also pushing the number of redundancies in the entity. With all this, the entity, as we discussed, is planning an IPO. They are planning to raise amount of 500 crores. Now, the objective of that offer would be uh, to increase the amount of working capital. Right now, they have a limit of 350 crores on a consolidated basis, but again, they are short. They would be trying to use these proceeds to improve their working capital position. Uh, they will also like to expand their offerings to newer products. Right? We also talked about that Nox game, which is innovative. They're trying to have a dominant place in the gaming market, but with this of the proceeds of offering would also be used to engage into emerging area like metaverse, or they would leverage artificial intelligence and any other services to expand into new verticals or expand into partnerships. Uh, they would also try to use the proceeds to fund targeted acquisitions. So they are looking for organic as well as inorganic growth. They're trying to buy out new entities. Okay, so again, a longish kind of a answer, but I thought I will try to put that out for everybody's discussion about the McKinsey's 7S framework. So, as we all know, the McKinsey's framework is based on 7S. So, strategy, structure, system, shared values, skills, style, and staff. Right? So these are the seven parameters which the entity should consider when they are evaluating the McKinsey's 7S framework. So, if I have to go step by step from an assessment of the overall business strategy of Fastest Finger First Limited, uh, FFL is experiencing a strategic drift, right? They don't have a clear direction. And as we discussed previously, there is also a resistance into a new initiative. So that's the problem statement that we discussed. Now, what should the entity do? To address this strategy must be communicated effectively to all managers and employees involved. So unless you communicate, you don't know where we all are heading, right? Uh, so a clear-cut communication should come out from Mr. Viper or maybe any other business heads, uh, which will very clearly lay out and communicate the overall objective of the entity. Now, as we also discussed from a strategy perspective, the current approach of combining organic as well as inorganic growth, it needs refinement, because particularly there is a risk that is associated with the Teen Patti contract, where we know that it would not be renewed, right? Uh, so as a recommendation, the entity should have clearer focus on product development, enhancing the premium gaming experience, right? This will only help the entity to have a competitive edge. So that's what our findings and recommendation from a strategy perspective. If I have to move to the second S, which is structure, right? So again, from a strategy perspective, they would need to restructure the entity where there is an unclear vision, and they would need to see whether they are able to structure the business in a much more better way. Systems, right? The company is transitioning to Ind AS and dealing with GST compliance issues, right? I think they should have more robust internal control systems so that they can handle these complexities and addressing compliance, and as well to maintain investor confidence. So if you would recall from the entity is transitioning from AS to Ind AS. Ind AS is a very very judgmental kind of accounting framework, especially the accounting on financial instruments is extremely complex. So, similarly, the GST matter on the online gaming industry as a whole is evolving. And unless we have very strong systems or controls in place, there is a possibility of slip up, and which might damage the entity's reputation or financial performance. So, and hence, it is utmost important that they invest heavily into stronger and robust systems. Values. As we discussed, there is a lack of consensus on whether we need to develop new product, or there is a need to develop a new product at all. There is a difference in leadership. So there's a difference between the views of the leadership and the staff. We talked about growing discontent and disgruntled employees. So possibly again there is one area which the entity should be looking at. Again, a problem statement. The CEO's concern, Mr. Viper's concern about entity's future has not been communicated very, very clearly, right? The culture of innovation and alignment with newer developments are not in place. So there is a very big disconnect uh, uh, or a resistance by various people to look for newer options or to adopt a change. So unless the CEO communicate his vision very very clearly, it is likely that the employee and the leadership relationship will only go sour, and there is a need to mend that relationship very very quickly. Now let's talk about skill. Now, Future Forward is lacking expertise in new gaming technologies, right, which is critical for developing new products and maintaining competitiveness. One quick way is to invest in hiring senior resources for research and development. As we know that this sector is very very niche, and it is very very uh, agile or susceptible to changes in external circumstances. So unless you keep the content fresh, it is difficult to maintain or retain the loyalty of the customers, and hence it is very important that the entity retains and invests in hiring senior resources. Again, the next S is the style, right? There is internal disagreements, right? And that is causing friction between the staff and the leadership. The CEO has not secured commitment from key managers like sales and operations. Uh, so it is very important for the leadership to resolve these conflicts and create a collaborative environment to encourage innovation and adaptability. Uh, Lastly, as far as the staff is concerned, there is a growing human resource challenge, including potential redundancies. So it is very much required that there is a effective HR management, right? Communication of strategic changes, exit interviews, and talent acquisition. That is the need of the hour. Now, on an overall basis, if we have to conclude on the 7S framework of FFL, uh, FFL would need to realign its strategy by refining its growth, revisiting organizational structure, and investing in key technologies and skills. Right? Clear communication and a fostering of shared vision are essential. Right? It is at most important that the internal conflicts are resolved. A collaborative environment is forged where everybody can help uh, in getting to the objective of the company, and this will only upheld the competitive position in the entire gaming industry. So I think that's all I had to cover. If there is any question on any of the topics that we discussed, or Deepak, if there are some questions that you have got separately, happy to discuss. But back to you, Deepak.
Uh, Thank you, sir, for sharing such valuable insights on approaching IBS case studies with the right mindset and strategic thinking. Students, please go ahead and raise your queries. If you have any questions, please ask now. In my chat box, there is question
Yeah.
from Nandita.
Okay.
Sir, this is from BOS. Uh, uh,
Sure.
how to prepare the IBS exam for September attempt. Students, for this, begin your preparation by revising the fundamental concepts from your core subjects like FR, AFM, auditing, direct tax, indirect tax. Simultaneously, focus on key strategic and regulatory areas. Focus on strategic models like Porter 5 forces, SORT, McKinsey 7S, value chain, Altman's JAD score, etc. Know how legal provisions apply, especially to company structuring and board responsibilities. SEBI LODR regulations are very, very important. Again, for every listing company, it is very important, and surely you may get some questions from this area. AFM are crucial. In AFM, forex concepts are very, very important. If any company is having international operations, then you may get some questions from forex portion also. And FEMA regulation are also very, very important. Then you have to practice from ICAI's resources. ICAI's resources are very good, and there are a lot of case studies. Currently, we are having around 80 case studies, and nearly 50% of case studies are based on real companies. This help you to relate your textbook concepts with actual scenarios. Now, don't miss key concept of your timeline. By June end, look out for new case studies in the upcoming RTP. In upcoming RTP, you will get two case studies on automobile sector. Attempt them without referring to suggested answers. These might be tricky or complex, okay, but it will prepare you for your coming exam. In July, attempt mock test paper 1 in examination condition. This will help you in identification of your weak area, practice time management, gain confidence, and you can use feedback in coming mock test paper. In September, just before the exam, attempt mock test paper 2, but you have to attempt with equal seriousness. This final mock will help you to fine tune your approach. Treat every case study seriously. The IBS paper is not just about solving questions, it is about thinking like a decision maker. Next query is from Balakrishna. Uh, During the examination, sir, please give us special tips. Okay. First of all, in examination, first of all, start by going through requirement part. Okay. Identify the ones you are most comfortable with. This helps in better time management and boost your confidence. Don't ignore MCQ section. Since MCQ carries 40% weightage, keep an eye on them. Keep eye on them during initial reading. A wrong selection in beginning can waste your time and affect your ability to attempt full paper. While reading a case study, jot down key points based on question requirement. For example, if a question is related with IND AS 41, mark or note down important words, figures, paragraphs that seems relevant. This early step is extremely useful in drafting your final answer. I normally say this a sketch making. You have to make rough sketch of your case. You may need to refer to study material during the exam. It is very important. Students, it is very important. You may need to refer study material in your exam. Some students create own index to navigate quickly. That's fine. But the best index is your mind. If your concepts are clear, you can scroll and find what you need efficiently. If not, you may end up with wasting your time in searching, and even after finding the content, you may not be able to apply concept correctly. For example, it is a real example I am giving. In November 24, there was a question on ECB norms. A student who had studied the concept could refer quickly and apply it. Others spent too much time on looking, still couldn't apply well. This exam is not about hunting the answer in the module. It is about how well you understand or apply concepts. If your concepts clarity is strong, you will surely do well. And one more important thing is start answering on the left hand side pages. This gives you right hand side page for your rough work. Always attempt all required questions. Make sure you cover all parts of your questions. Next query is from Priyanka. Please tell what are the books we need to carry in examination hall during IBS exam. Students, again it is important. Feel free to refer any study material you are comfortable with. Okay, it is advisable to carry the material that forms the foundation of your preparation. In addition, any mind map or chart you have created to simplify concepts like Companies Act, SEBI, LODR, corporate governance, McKinsey 7S, or any accounting standard or any formula, it will be very useful. In fact, creating your own mind map is highly recommended. But why? Because the best mind map is the one which is prepared by you. When you make it yourself, you remember the flow better and know exactly where to find what during the exam. It helps you to link concept with clarity and apply the concept very quickly. Remember, the focus of this exam is on application and analysis, not just recall. So, take only those materials that help you in applying the concept. Students, you may ask queries. Rajiva, Devrat, Geeta, Smriti. Students, please ask.
Sir, in IBS paper,
Hmm,
there is a 40 pages paper is there. Question paper is of 40 pages.
hmm.
Then 15 minutes are given to the students for reading that paper. How that paper, 40 pages are read by us in 15 minutes.
Actually, out of 5, you have to attempt only 4 case studies. Okay, and you may select a case study based on your comfortable area.
So, but without reading, how can we decide that which case study we have to solve?
Actually, when you look at the case study in first glance, you may get some idea. Suppose some type of flavor. Okay, whether which model they have asked, or which type of accounting standard they are asking. That's why I told you to start with requirement part. First, you have to start with requirement part and select the case study carefully. This is very, very important in your examination. Case study selection is very, very important. And for this, you have to start with requirement part. After reading requirement, you may be easily able to understand whether you are comfortable with it or not.
Okay, sir. Thank you.
मीडियम के स्टूडेंट्स के लिए भी थोड़ा सा एक्सप्लेन करूंगा ये जो मैंने अभी आपको समझाया है। बेसिकली अगर आपको एग्जामिनेशन के अंदर कोई भी केस स्टडी अगर अटेम्प्ट करना है तो सबसे पहले आप उसको रिक्वायरमेंट पार्ट से उसको देखिए। सबसे पहले आप उसका रिक्वायरमेंट पार्ट देखिए कि कौन सा अकाउंटिंग स्टैंडर्ड, कौन सा बिजनेस मॉडल या कौन सा रेगुलेशन उस केस स्टडी के ऊपर एप्लीकेबल हो रहा है। लेकिन साथ में रिक्वायरमेंट पार्ट के अलावा एमसीक्यू को भी देखना इंपॉर्टेंट है, क्योंकि उससे भी आपको आइडिया मिलेगा, क्योंकि एमसीक्यूज की जो वेटेज है वो भी 40% है, वो भी अपने आप में रिलीवेंट है। एक केस स्टडी अगर 25 मार्क्स की है तो उसके अंदर 10 मार्क्स का जो है वो एमसीक्यू है। तो इसलिए फर्स्ट ग्लैंस के अंदर आपको देखना है रिक्वायरमेंट क्या है केस स्टडी की, साथ में एमसीक्यू के अंदर क्या रिक्वायरमेंट है, क्या आप उस एरिया से कंफर्टेबल हो या नहीं हो। अगर आप उसके साथ कंफर्टेबल हो इजीली, तो आप उस केस स्टडी के साथ गो हेड कर सकते हैं। अब जब आप उस केस स्टडी को आपने सिलेक्ट किया, तो फिर आप उसको रीड करना शुरू करते हैं। जब रीड करेंगे तो रीड करते करते आप उसका एक स्केच तैयार कीजिए रिक्वायरमेंट के बेसिस पर। अगर सपोज केस स्टडी के अंदर होता है कि इंड एस 41 से रिलेटेड क्वेश्चन है, तो उससे रिलेटेड जो पॉइंट्स और फैक्ट्स हैं उसका एक रफ स्केच तैयार कीजिए, क्योंकि जब आप फाइनल आंसर ड्राफ्ट करेंगे तो वो आपको बहुत यूजफुल होगा। तो इसलिए किसी भी केस स्टडी में ये अप्रोच जरूर फॉलो कीजिएगा। स्टूडेंट, एनी अदर क्वेरी? Okay.
Thank you, sir.
Okay. As we come to end of this insightful session, I would like to express our heartfelt thanks to our speaker, CA Nilanjan Paul sir, for taking the time to be with us and for sharing his deep knowledge and experience. Your discussion showed us how tax laws, financial reporting, regulations, and strategy are all connected with a company wants to grow responsibly. This kind of integrated thinking is exactly what the integrated business solution paper is all about. To our students who joined today, thank you for your active participation. Let today's session serve as a reminder that IBS paper goes far beyond just solving case studies. It is about developing the mindset of a decision maker. Keep learning, keep exploring, and most importantly, keep practicing. Students, here practice is very important. Do practice. Do large number of practice of case studies. Wishing you all the best in your preparation. Once again, a big thank you to CA Paul sir and to everyone who made this session a success. Thank you, students. Thank you,
Thank you,
sir.
Deepak. Thank you, Deepak, and my regards to all the students and best of luck.
Thank you so much, sir.
Thanks, sir.
Yes, you can close.